Okay, now it's recording. Your exams have not yet been graded because I didn't have time to go over and get them graded from the machine when I was here on Tuesday. But I will get those graded this afternoon. I will get them posted by noon tomorrow. And then I'll have them in class next Tuesday to look at and see what you missed. Any questions before we get into chapter 11? All right. Chapter 11 is a really important chapter. In fact, I would say that I like the book in almost every way, except I believe that in this chapter, they tried to do too much. In a lot of books, they have a whole chapter on cost because there are different ways to measure cost. And then they have a separate chapter on profit maximization. What does the firm have to do in order to maximize profit? This book has combined those into one chapter, and that's quite a bit of material to cover. But it's still a good chapter. Every producer has to answer 3 questions. In reality, obviously, producers have to answer lots of questions. Running a business is not a simple thing. People often who don't have any experience with business think, well, managing a business, man, that's just that's not very challenging. Anybody could do that. That's what Lenin thought when the Soviet Revolution back in 1917, that we'll just get rid of all the managers and we can, anybody can manage a business. And he found very quickly that things didn't go well when he got rid of the people who knew how to manage the business. So running a business is very complicated, but the basics, you've got to start with 3 things. What price are we going to charge? How much are we going to produce? You might think that, well, firms they produce as much as people want to buy, or they produce as much as they can. Absolutely not. We're going to see that there's going to be a particular quantity that will give them maximum profit. And if they produce more than that, or they produce less than that, then they're not going to make as much profit as they could. So what price to charge, what quantity to produce, and then when should the firm be producing at all? When should a firm enter a market, start producing? When should they decide it's not worth it and they should go out of business? Well, those are all foundational questions that a business has to deal with. And in this chapter, we're going to answer those questions for a particular type of market. Markets vary from one to another, and we are going to talk about the standard 4 market types. Chapter 11 and 12 deal with one type, 13, 15, and 17 deal with the other 3 market types. And we're going to see that the details of how a business operates will vary depending on what kind of market it is operating in. And the terminology here can be very confusing. In 11 and 12, we're talking about, quote, competitive markets. And that may not correspond to what you think of as a competitive market. When we talk about a competitive market, that is the same as saying a market operating under perfect competition. It's the same as talking about a price taker market. So these 3 terms mean the same thing in terms of an economics course. And we'll define what we mean by these in just a second. But let's go ahead and give an overview of the other types of markets we'll be looking at. Chapter 13 deals with monopoly. And that one is more obvious than the others. What would you think a monopoly market would be?
One big producer.
The obvious thing you would expect is if it's a monopoly, you've got one producer. So in a sense, it seems like it's very straightforward. But in reality, it's not nearly that clear cut. For example, Coke. Does Coke have a monopoly?
There's alternatives.
There are alternatives, but there's only one firm that can produce Coca-Cola. So if you literally say a monopoly is where you have one firm, then it would qualify as a monopoly. So we really have to be a little more, and we could also say McDonald's would be a monopoly because nobody can sell McDonald's hamburgers other than McDonald's. But is that really a useful way to define it?
It seems like it's way too specific.
That's too specific. What we're going to end up saying is that a firm, there's a market is a monopoly if you have one seller of a product for which there are no good substitutes. Okay? If you were the only producer of insulin, then you would have a monopoly because there are no good substitutes for insulin. But being the producer of Coca-Cola, there are pretty good substitutes for Coke, Pepsi, Dr. Pepper, all these other things. So it really doesn't make sense to call that a monopoly. Okay? And the question of exactly how we're going to define monopolies is going to be somewhat complicated. What we'll end up doing is spending our time thinking about if we have a market where it really is a monopoly, one producer, no good substitutes, how will that monopolist act? That's what we'll try to identify. In fact, for each of these, we're going to define these different market types and then say, for a firm operating in this kind of market, how would that firm operate? And then once we understand all of these, we can come back to specific markets and say, okay, which market type would this belong to? Third market type, oligopoly, is in chapter 15. That is where you don't have a monopoly, you've got more than one firm, but you don't have very many firms. We'll see that with the competitive markets, you've got lots of firms. With monopoly, you've got one firm. With oligopoly, you have a few firms that are very much aware of each other. Under oligopoly, you have interdependent behavior. Think about the auto industry, especially not as much now as it was 30 years ago, but it still would be an oligopoly. 30 years ago, you had the big three, Ford, Chrysler, and GM. And when Ford set their prices, they were very much aware that the other competitors were watching what they did. And so when one firm cut its price, it was thinking about, how are my competitors going to respond? Are they going to cut their price? Or are they going to keep their prices the same? So oligopoly gets rather complicated because each competitor is watching the other guy and trying to anticipate what they're going to do. So anytime you have a market where you have just a few firms and where the firms are watching each other to see what kind of prices they charge, that would be oligopoly. Then the fourth market type is called monopolistic competition. Notice it sounds kind of like monopoly, sounds kind of like competitive markets. And it is a combination of the two. With monopolistic competition, you have a large number of firms, but each firm is selling a product that's not exactly the same as what the other firms are selling. We call that heterogeneous products. They're not identical to each other. Whereas we'll see with competitive markets, you have homogeneous products. You've got lots of firms, each firm is small, and the product produced by firm 1 is the same as the product produced by firm 2 and 3. It's all the same. They're all producing exactly the same product. And so those are the 4 types of markets we'll be talking about. And I think these 4 markets structures do give you some good insight into how firms make decisions about prices and about quantities in the real world. One thing to note, as I mentioned, when we talk about a competitive market, okay, that is the same as saying it is a price taker market. And to be a price taker market means the firm says, I don't have any control over the price that I charge. In this type of market, each firm looks at the market price. He sees what everybody else is charging, and he says, I have to charge the same price. I don't have any choice. The characteristics of this type market, or that identify this type market, you got lots of firms. Most of the firms are very small, and they're selling homogeneous products. So if you go to the consumers and you say, well, which producer would you prefer to buy from? The consumer says, I don't care. I'm going to buy from whoever offers me the best price because they're all selling exactly the same thing. Okay? That's what a price taker or a competitive market is. Okay, so the question of what price to charge in a competitive market, it's a very simple question to answer because the firms are price takers. Each firm says, I have to charge the same thing that everybody else is charging. And that means that as long as the firm charges that market price, the firm can sell as much output as it wants because it is such a small part of the market. Its actions will have no effect on the market price, as we'll see in just a second. Also important to recognize, if it's a competitive market, then a firm will not be able to sell any output, or that's a mistake here. Firm can't sell any output at a higher price. If the market price is $5 and the firm says, well, we'll charge $5.10. So really a competitive market, who's going to buy at $5.10? Nobody. So the amount the firm can sell above the market price drops to 0. And the firm has no incentive to ever charge below the market price. Because in this type market, it can sell as much as it wants to sell at that market price. There's no reason to cut the price. I mean, just think about it. In the markets you're familiar with, why does the firm ever cut its price? What are they hoping to do? They're trying to sell more. In a competitive market, a price taker market, the firm doesn't have to cut the price to sell more. They can sell as much as they want at the prevailing market price. Now, to make that a little more concrete, let's consider an example. A lot of agricultural markets would be roughly price taker markets. Let's say this is the market for wheat. We're going to assume, and I did a little research trying to get numbers that would be somewhat reasonable. Let's say that the total world production of wheat is 2 billion bushels. So you got your market demand, market supply, and you have an equilibrium price of $6. Okay? We're going to make the assumption that all wheat is exactly the same, or if it's different, we're only looking at one particular type of wheat. Okay? It's fine for there to be different types, but we're focusing on one type, so that in this market, the consumers say, we don't care who we buy from, because they're all selling exactly the same kind of wheat. So this is just our basic supply and demand from chapter 3 and chapter 4 that we've been dealing with all semester. But now we're also going to think about, how does the situation look to the individual farmer? Okay? Lots of farmers in the market selling this huge quantity. But now we're just looking at one individual farmer. Okay? And let's say that he is initially, so he is initially producing 300 bushels. Okay? And he finds that he's able to sell it at the $6 price, okay? The market price. And let's say that he decides he wants to produce more. So he decides to expand his output tremendously. He's going from 300 bushels to 700 bushels. That's over a 100% increase. Huge increase for him from his perspective. But in terms of the overall market, what happens? The total quantity produced is going to go from 2 billion to 2,400,000,000. Okay? And that is going to have no noticeable, no appreciable effect on the market price. Okay? Remember, think about the market demand curve here. That point on the demand curve says that to get people to purchase 2 billion bushels of wheat, the price has to be $6. So if the quantity, if you want consumers to buy 2,400,000,000 bushels, what does the price have to be? Well, if you're moving from 2 billion to 2,400,000,000, yes, you are moving a tiny bit to the right, and that means you are moving a tiny bit down the demand curve.
So would it still be in that equilibrium zone?
Yeah, it's going to be, if we could measure it, it might go from $6 to 5.9999999. Okay? Technically, does the price go down a tiny bit? Yes, but it's going to be so small, because this farm is so small compared to the overall market, that for practical purposes, we can say to this one farmer, what you do has no effect on the price. You can expand, you can contract, doesn't matter what you do. You are so small that your actions aren't going to have any effect at all on the market price. The price is going to be $6. You can take that price as a given. Okay? So if he wants to produce 300 units, he'll have to sell it at $6. If he wants to expand out to 700, he'll have to sell it at $6 per unit. If he wants to expand even more, produce 1,200 units, he's still going to have to sell it at $6 per unit. So the demand curve, or the demand faced by this one farmer, demand for his product, is horizontal. Okay? He can sell as much or as little as he wants, but the price he charges is going to have to be that market price. Okay? So even though the demand for wheat is negatively sloped, the demand for this one farmer's wheat is going to be perfectly horizontal. And what do we call that in terms of elasticity?
Perfectly elastic.
Call that perfectly elastic, okay? Which means consumers are extremely sensitive to a change in the price. He can sell as much as he wants at the $6 price, but if he tries to raise it to $6 and a nickel, then the quantity he will be able to sell drops to zero. They're very sensitive to a change in the price that he charges. Very elastic. And why? Because they have lots of good substitutes. We're assuming that you've got lots of other producers who are producing wheat that's just as good as his. So if he raises his price at all above the other producers, they say, no, why should we pay you more? We will just buy from somebody else. So there really is no price decision for firms in a price taker market. They have to charge the market determined price. Okay? Question about that. Notice we have one graph that shows us the overall market supply, all of the producers, all of the consumers. Then we have the graph on the right that is focused just on this one farmer, how much he'll be able to sell. And eventually we'll have a curve here that will represent the cost that he's going to be at. Okay. Another example, the oil market. We don't typically think of the oil market as being only small firms, because there are some large firms. But the book makes a good point that you do have lots and lots and lots of very small oil wells called stripper wells, where each day they're producing a very, very small quantity, 10 barrels or less. So in many ways, it would fit what we're calling a competitive market. So you've got the world supply, you've got the world market demand, and the quantity that is produced, quantity demanded on a daily basis, is 82 million barrels. And at this point in time, the equilibrium price is $50. I haven't looked lately. I think it's around $39 a barrel right now. Oil has sold as at a price as high as $150 a barrel back in, I think that was early 2008. And we mentioned before, it has sold for as low as minus $37 a barrel. So it bounces around. 50 would be probably pretty close to an average. Okay? So we're saying we got this world market represented on the left. On the right, we're looking at one individual owner of an oil well. And whereas the overall market is producing and selling 82 million barrels a day, the individual firm is producing a very, very small quantity. Here, if they're at 2, then they can produce that. They can sell it if they charge a price of $50. If they decide to produce more, go out to 5 or to 10, well, that's a big increase for that one firm. But an 8-unit increase relative to an 82 million overall market production, that 8 increases is negligible. It's tiny. So the idea that this one firm's actions could have any effect on the price is ridiculous. So this firm, the small firm, would be a price taker. Small firm simply says, what What's the price? I have no control over it. Takes that price and he says, I can produce as many units as I want. I can sell as many units as I want, as long as I charge that market price. So, remember we said there are three questions the firm has to answer. One, what price to charge for a competitive market? It's easy, just looks, what is the market price? But then the second question is, okay, how many units should the firm choose to produce? And that's not at all obvious. In fact, you can't determine that from this graph. We're going to have more information. Okay. There will be a number of terms that we're going to introduce in this chapter that we'll be using later on. And two of them are long run and short run. When we talk about the long run, we're talking about a time that time frame that is long enough for firms to enter the market, for existing firms to expand, to build new factories, things like that, buy new equipment. It's also long enough for existing firms to get out of any contracts they're in and choose to go out of business. When we talk about the short run, we're talking about a time period that's so short that it's not enough time for new firms to enter. It's not enough time for existing firms to expand by buying more machines or building new factories. It's not enough time for them to get out of their existing contracts. Okay? We'll come back to that distinction in a while. So to test your understanding, in a perfectly competitive market, which again, same thing as price taker, a firm will set its price equal to its cost of production, equal to its cost plus a normal markup, equal to market price. What's it going to do? Yes, you in back.
They have to set their price to equal the market price.
The firm has to set the price equal to the market price. We're not saying that that's what it wants to do. Okay? In many cases, it does not at all want to charge the market price. When the price of oil was minus 37, the firms did not want to charge that. Okay? We're saying that in a competitive market, the firm has only one option. It has to charge the market price. Okay? Now we'll see in the other type markets, the other three, those are generally called price searcher markets. Price searcher. So we're distinguishing between a price taker market and price searcher markets. The first market type, the competitive market, is a price taker market. Firms, I have no control over the price. The other three types of markets are price searcher markets. That means the firm has to search for, they have to try to figure out what is the best price for us to charge. Because in these other three market types, firms do have some control over the price. Okay? How much control will vary, but they have some control. Okay. This chapter is all about profit maximization. What does a firm have to do, not just to get profit, but to get maximum profit? So we begin with the basics. What is profit? Total revenue minus total cost. Two important questions. One, what is total revenue? How do we calculate that? And two, what are costs? What should be considered a cost? And how should we measure cost? You might think, well, that's, cost is cost. But no, we're going to see there are 5, 6 different ways we can measure cost. And there's some things we need to be sure to include, some things we need to be sure to exclude. Yeah, go ahead.
So you say, well, what are the the cost of the bills to run the operation?
The bills to run the operation, we will see that those bills will be part of the cost, but that's not the whole thing.
Because then there's fixed costs, variable costs.
Fixed cost and variable cost, that's another way. Cost is actually very complicated. And some costs are fixed, some are variable. And for some decisions, they're all relevant. And for some decisions, only the variable are variable. So it's are relevant. So it's important chapter. It's going to lay out some foundational ideas that will apply in other chapters. So first, total revenue. What is it? Total revenue is price times quantity. We are going to be assuming, except for in chapter 14, we are going to be assuming that firms cannot price discriminate. Yeah, go ahead.
4 o'clock is closing the streets. I don't know if you remember that.
Oh, yeah. Okay. And
For the parade,
if I park over here, will I be able to get out?
not after 4.
Hmm. I have to think about that.
I don't mean to interrupt.
Okay, thank you for reminding me of that.
They sent out an email, so maybe if you read which streets it is, it might.
Okay. Okay. Thanks. For almost this whole course, we will be assuming that for each product, there is only one price. The firm decides what they're going to charge, they set that price, and then they sell to everybody who wants to buy at that same price. The alternative to having a single price is to have price discrimination, where it can be that you're charging different customers different prices. It's like you go to buy a car. If 3 people come in to buy the same car, they're likely to end up being charged different prices because the salesman is trying to get the highest price he can from each one. So there's price discrimination there. But then you also have price discrimination in terms of sometimes you will have buy one, get one free, or get one 50% off. So basically they're charging you a higher price for the first unit, lower price for the second, and so on. Price discrimination can be a very, very profitable thing for firms to do. And we will talk about that in chapter 14, but for most of what we do, we will not get into that because that does make things more complicated. Okay? So as long as the firm is charging the same price to everybody, then total revenue is easy to calculate. The price per unit times the number of units that are going to be sold. So calculating revenue, not very hard. But then that brings us to the question of cost. What should we include as a cost? And this principle of rational choice is really, really important. It doesn't just apply to a business trying to make profit. It really pretty much applies to everything in life. Ignore what you can't change. Focus on what you can change. There are many things in life that are up to you, many things that aren't up to you, that you can't do anything about. And so you have a choice. Am I going to focus my thought on the things that I can do something about, or on the things that I can't do anything about? And just as a philosophy of life, you're much better off focusing on the things that you have some control over. And there's a great economist, I think it was Frank Knight, who said, whatever is necessary is optimal. Meaning that if you can't do anything about it, don't focus on it and fret about it and worry about it. Just think of it as optimal. That is, this is the best we can do. And devote your attention to other things. So it's a very good principle in general, but it's very important also when we're thinking about a business's cost, because this takes us to sunk costs. A sunk cost is a non-recoverable cost. It's a cost that you have incurred and you can't do anything about it. Okay? You cannot reverse it. Okay? Like going to, you want to go to a concert and you pay $100 for the ticket. Okay? Well, before you bought the ticket, you haven't incurred the cost yet. You buy the tickets. Let's say that it's refundable up until 3 hours before the concert starts. Okay, well, it's not a sunk cost if you can change your mind and get your money back. But at some point, that cost is non-recoverable. You can't get your money back. The idea here is that if something is a sunk cost, then it's non-recoverable, and that means it should be ignored. Sunk costs should be ignored. If you pay $100 for the concert ticket and it's too late to get your money back, let's say it's too late to sell it to anybody else, okay? There's nothing you can do with that ticket other than use it. Okay? Economics would suggest that you should ignore the cost that you paid for the ticket. Let's say that you find out that this is for a concert for a piece of music that it's not what you thought it was going to be. And it's something that you really don't like. Some people would say, well, I paid $100 for this ticket, so I'm going to use it, because if I don't use it, then I'm going to lose that money. The reality is you've already incurred that cost. You can't do anything about it. So in making your decision, you ignore what you paid for the ticket and you look at, well, what are the future costs and the future benefits? If I go in and listen to this concert, what's the benefit I'm going to get from it? And what's the cost I'm going to incur? The cost is not the ticket, because you've already incurred that. We're assuming you can't get it back. So the cost of going and hearing the concert would then be the opportunity cost of your time. So if you have nothing else you can do with your time and you get a little benefit from hearing the concert, well, then go ahead and hear it. But if you paid $100 for the ticket, it's a sunk cost. And if you say, I'd really enjoy just going home and sleeping more than going to this concert, then you should go home and sleep. And if you say, but then I would lose that $100, you're forgetting that you should ignore sunk cost, because you've already lost that $100. If it is a sunk cost, then you cannot recover it. And if it's non-recoverable, then you should ignore it. Let's say you have, you're in college, as you are. Let's say that you spend 3 years studying for a degree in some other field. And you decide, I don't like this. I don't think I want to work in this field. But somebody says, oh, but you spent 3 years studying this. And if you don't finish that degree, then you'll have lost all of that. Okay? They're encouraging you to base your decision on a sunk cost, because you've already incurred the cost of taking all those classes. You can't get that cost back. What you should do is base your decision. You ignore the sunk costs in the past, and you focus on what are the future benefits of finishing the degree, and what are the future costs of finishing the degree. The sunk costs that are in the past, you ignore. Okay? You focus on, from the present going forward, what's going to cost me to finish, what are the benefits going to be? And if those future benefits outweigh the future costs, then it makes sense to finish. If the future benefits are less than the future costs, then you say, no, I'm not going to finish this. I'm going to go do something else. And you don't say, but you're going to lose those 3 years. No, you incurred that cost as you were going through those years, and there's nothing you can do to get it back. Okay? So in thinking about the costs that are relevant to a firm, sunk costs are not going to be relevant. Once they are sunk, once they cannot be reversed, then they should not affect our current decisions. Also, costs that should not be considered when making short-run decisions, fixed costs. Okay? What are fixed costs? Fixed costs are costs that do not vary with output. That's why they're called fixed costs. They cannot be changed by short-run choices, so they should be ignored in the short run. And we're not saying they're irrelevant for all decisions. Okay? Fixed costs can be changed by long-run choices. We'll talk about that a little more later. So the fixed costs are relevant for some choices. We're saying that when we're making short-run choices, and by short run, we mean a period that's so short that we cannot escape those fixed costs, then we don't take those into account. Some costs are fixed, the other costs are variable, and those are simple. As you would expect, costs that do vary with output. So if you don't produce any output, what will your variable cost be? If they're costs that vary with output, then the more you produce, the greater they're going to be. If you don't produce any output, you're not going to have any variable cost. Okay? Variable cost will be zero if you're producing a quantity of zero. But as you produce more and more, your variable cost will get higher and higher. We'll have a table to go through this in just a second. When deciding what quantity to produce, that's really what we're dealing with here. We're trying to figure out which cost should we look at so that we know how to decide how much to produce. Okay? And you might think, well, who cares how you make this decision? Imagine that you have, imagine that you just inherited $1 million, or a business that is that's worth $1 million, or you're told it's worth $1 million, and you have to now make the decisions about how to run it. Well, if you make good decisions, if you know how to figure out the right price, you know how to figure out the right quantity, then you can make a lot of profit, your wealth goes up, you and your family can have a high standard of living. If you don't know how to answer these questions, then your firm is going to lose money. That means your wealth is going to go down, and you and your family are going to have a low standard of living. So connect these questions, these choices, to the results. Knowing how to answer these questions leads to profit, it leads to higher welfare. Not knowing how to answer the question leads to losing money, going out of business, and unemployment. So in deciding what quantity to produce, ignore sunk cost, ignore fixed cost, focus on variable cost. And here's an example, numerical example, to help us think through some of these. This is for a hypothetical rollerblade company. Notice we've got, anytime you have a graph or a table, you stop, take some time to take in what is there. First column, output per day. So you can not produce anything, you can produce up to 11 units. Okay? Second column is giving us the total fixed cost. TFC represents total fixed cost. And if it's a fixed cost, what would you expect? Yeah.
going to start lining up in front of chambers before 4 o'clock and block any cars that are holding in.
Before, okay, well, as soon as I'm out here, I'll move. Thank you for warning me about that. Okay, so for fixed cost, if it's fixed, means it doesn't vary with output, so we should not be surprised that fixed costs stay the same. They don't vary with output. So if you have a fixed $50 fixed cost, it means if you don't produce any output, you're still going to have that $50 cost. If you produce 10 units, your fixed cost is still going to be 50. Now you're going to have variable cost. Okay? Your variable costs go up. You can see that here. If you don't produce any output, variable cost is going to be 0. And every time you expand and produce more output, your variable costs get higher and higher and higher. Okay? Total cost, what is it? Well, total cost is the sum of the costs that don't vary with output plus the costs that do vary with output. So that's fixed cost plus variable. Just add these two columns together and that gives you total cost. So for every level of output, let's look at 11. Okay, the total cost is $252. Why? Well, because you got $50 of fixed cost plus $202 of variable cost. And that gives you this column here. So here we're starting out, we're given these three columns. All of this is what is given. And then from that, we can calculate all these other measures of cost. Total cost, which is all of these costs, but also these other measures. AFC is average fixed cost. Think about what that means. Now, you might wonder, why are we developing all these different measures of cost? Because different measures are relevant for different things. And the firm wants to make the best decisions that it can.
What was the AFC? Is that actual?
Average. Average, yeah. Actually, here is a glossary on cost. Average fixed cost, AFC, is total fixed cost per unit. Anytime you have just think about it, anytime you have an average, what are you doing? You're taking some total and you're spreading that over the number of units that you have, okay? So with average fixed cost, you're taking this total fixed cost of 50, excuse me, and you are spreading it over the quantity you're producing. So if you produce only 1 unit, your total fixed cost is 50. You're spreading that 50 over 1 unit, so your average is $50. If you expand and produce 2, well, your fixed cost is still 50, but you're spreading it over 2 units. So you have this dramatic drop from 50 to 25. Notice that every time you expand and produce more, you're spreading the fixed cost over a larger and larger quantity. And that's why average fixed cost always decreases as the firm produces more. But notice at first, when the firm expands, you get this huge drop, 25, 16, 12.50. So you have a big drop, but as the firm is expanding more and more, it's not dropping very much. When you go from 10 to 11, it's only going from 5 to 455. Okay? So expanding and getting bigger doesn't benefit the firm that much once it's already fairly big. But if you have a firm that's really, really small, then there are huge benefits of expanding. Okay? That's why if you have in an industry where they have high fixed costs, like the airline industry, where they have to spend billions of dollars just to build a hangar before they build the first plane, there are huge, what we're going to call economies of scale. You don't want to start an airline company if you're only going to build one plant or one plane. Okay? Once you build that factory, you want to produce a large quantity so you can spread those fixed costs over a large quantity. Okay? Notice the total variable cost. Every time the firm expands, it gets larger. Notice that the same is true for total cost. It's always going to get, you produce more output, total cost is going to go up. ABC, these different measures are going to come into play at various times in the future. Average variable cost is simply taking total variable dividing by the quantity. And you can see as the firm expands, average variable cost gets lower at first. Okay? Just like average fixed, it got lower and lower and lower. Does average variable continue to go down forever? No.
It's going to hit some point where it pops back up.
As the firm is expanding, average variable cost gets lower and lower to a point, but then if the firm continues to expand, average variable cost starts getting higher and higher. Okay? Same is true for average total cost. You would find that just by taking the total cost dividing by the quantity. That would give you average total. Think about what that represents. You're taking the total cost and you're spreading that over the number of units that are being produced. So if you produce 1 unit, total cost is $65. You're spreading it over 1 unit, so average total is 65. Produce 2 units, total cost increases to 75, but you're spreading it over 2 units, so average total goes down to 37.50. Notice as the firm is expanding, getting bigger, average total cost is getting lower and lower out to a point. But if the firm continues to get bigger and bigger, then average total cost starts to go up.
So is that the point of diminishing returns?
Question is, would that be the point of diminishing returns? No, you're on the right track, but that's not quite it. Okay, we will talk about diminishing returns a little bit later. Okay, that really has more to do with marginal cost. Okay? Marginal cost is the measure of cost that people tend to have the most trouble with. Okay?
I do. That's why I asked.
And in many ways, it's the most important. Okay, the definition. Let's see. Definition of marginal cost. It is the change. It's not a very good graphic there. The marginal cost is defined as the change in total cost divided by the change in quantity. Okay. Delta, the triangle means change. Marginal cost is the change in total cost divided by the change in quantity, or more intuitively, it's the extra cost that the firm bears to produce an extra unit. Okay. So for what's the marginal cost of producing the first unit? What's the change in total cost when the firm produces the first unit? If the firm is not producing any output, then its total cost is 50. When the firm decides to produce the first unit, its total cost goes up to 65. So the change in total cost is the increase from 50 to 65, which is a $15 change. So the marginal cost of that first unit is $15. Okay. Marginal cost of the second unit. Well, when you produce the second unit, total cost goes from 65 up to 75. So what's the change in total cost? Going from 65 to 75, so the marginal cost is $10. Okay? By choosing to produce that second unit, the firm is going to incur an extra $10 cost. And then continuing on, this means that when the firm chooses to produce a third unit, its costs are going to go up by 9. Fourth unit is going to go up by 8, and so on. Okay? Marginal cost is showing us the extra cost of producing each extra unit. And notice with average variable, as the firm was expanding, average variable got lower and lower to a point, but then it started to increase. Same thing with average total, got lower and lower, but then it started to increase. We see the same thing with marginal cost. Marginal cost is declining out to here, but if the firm expands, then marginal cost starts to increase. And that is the reason for marginal cost starting to increase is the diminishing returns coming into play. Okay. Okay, so we looked here at a number of different measures of cost. Not the most exciting thing to do, but these things are very important, and they're concepts that will be very useful as we start trying to answer some questions later on. Okay. Now, another distinction. We've introduced a lot of distinctions, a lot of concepts today. Another important distinction is the difference between an explicit cost and an implicit cost. Okay? And the distinction is pretty straightforward. A cost is an explicit cost if it requires a monetary outlay. Okay? If there's a if there's a payment involved, it doesn't have to be cash, but if there's a payment involved, then that is an explicit cost.
The rent charge to store something in a warehouse.
If you have to have, in order to run the business, you have to rent a warehouse, you have to pay for it. That's going to be an explicit cost. You're going to hire workers. Those workers will insist that they be paid. The wages you pay them would be an explicit cost. The payments you make for their benefits, their health insurance, things like that, that would be an explicit cost. You're going to be using electricity. You have to pay your utility bill. It's going to be an explicit cost. Lots of costs you're going to incur where you have to make a payment. That is an explicit cost. And you might think, well, then won't there always be a monetary cost? No. The other type of cost is an implicit cost. And this is a cost that does not require an outlay of money. Okay? With an implicit cost, there is an opportunity cost, even though there is no monetary cost. Now, what exactly does that mean? Here's just more examples. Explicit costs are the payments the firm has to make in order to purchase the services of the resources that it needs. So any resource the firm needs to produce its product and it has to go out and pay for those would be explicit costs. Taxes, interest payments, things like that. All of those are explicit costs. Implicit costs. That's what people have more trouble with. The opportunity cost associated with the use of resources that are already owned by the firm. So they do not involve monetary payments. So we're talking about resources the owner already has, so he doesn't have to go out and buy them. Okay. He doesn't have to pay for them. He's already got them. But there is an opportunity cost of using them. And the easiest thing to see would be the opportunity cost of the owner's time. If you are a engineer, let's say a chemical engineer, and you know that you could go work for another company and they would pay you, $110,000, let's say. But you decide that you want to run your own business, whether it's engineering or something else, doesn't matter. If you decide to run your own business, there is an opportunity cost to you of doing that. And if you know there's another company that would be willing to pay you $110,000, then if you decide to devote your time to your business, you are giving up that $110,000 salary that you could have had. Okay? It's an opportunity cost. You're giving it up when you decide to devote your time to your business. Okay? Now, it doesn't mean you have to pay yourself $110,000 with the cost of your workers. If you don't pay them, they're going to stop coming to work. Right? But you don't have to write yourself out a check for $110,000. Right? But still, you are bearing that opportunity cost because you were giving up that salary that you could have earned if you worked for somebody else. That's the idea of implicit cost. It's the opportunity cost of using resources the owner already possesses. Okay? Let's say you have the owner owns a building, okay? Already belongs to him. Well, he doesn't have to pay himself rent. Okay? But if he chooses to use that building for his business, then he's giving up whatever somebody else would have been willing to pay to rent that building. So let's say that he could have rented it out for $20,000 a month to somebody else. Then if he chooses to use it for his business, then he's bearing an opportunity cost or an implicit cost of $20,000. And he's making a huge mistake if he thinks, oh, it's not costing me anything to use my building because I don't have to pay myself rent. Now he's giving up what he could have gotten from somebody else. And that's a very real cost. It's not there's no monetary payment, but it is a very real cost that he should take into account. Opportunity cost of the owner's financial resources devoted to the firm. If the owner devotes $500,000 to his firm, if he invests that in his firm, there's an opportunity cost there because he could have invested that in bonds or in the stock market. He could have gotten a return on that investment. So whatever he could have earned on those funds, if he had invested them somewhere else, that would be an opportunity cost to him. And any other resources that are already owned by the firm, if he uses them in his business, then that means he can't use them in some other business. He can't sell them to somebody else. And so whatever he's giving up, that would be an implicit cost. Now, related to that, we have two more very important terms, accounting profit and economic profit. It may surprise you that there's different ways to measure profit, and accountants and economists measure profit differently. And really important, you know the difference. Accounting profit is total revenue minus explicit cost. roughly how many dollars come in and how many dollars go out. Okay? Economic profit is total revenue minus total cost. And total cost would be explicit cost plus implicit cost. Okay. Maximizing profit requires taking into account both explicit and implicit costs. To maximize profit, you have to take into account all of the relevant costs, and explicit and implicit are both relevant. Accountants don't consider all opportunity costs. They focus on explicit costs. And so accounting profits will be greater than economic profits. Okay. Now, are economists saying that accountants are doing it wrong? No. Accountants have a reason for the way they calculate profit. The accountants are dealing with the transactions where they can be fairly easily quantified. Okay? You can look at the bank's or the firm's checkbook and see, how many dollars were spent. It's very objective. You've got dollars going out. Whereas with economic profits, we are looking at the dollars coming in, we are looking at the dollars going out, but we're also taking into account the opportunity cost of the firm's resources where no monetary payment was made. There's no question that those implicit costs are important. Okay? Accountants would agree that those implicit costs are important, but because they're focusing on things that can be measured fairly easily, they don't take those into account when calculating accounting profit. Economists, we're interested in taking everything into account in our measure of profit. So even though implicit costs may be difficult to calculate, we subtract those out in calculating economic profit. And we'll see that in making any judgments about what the firm should do, the accountants, the economists would reach the same conclusion. They're just talking about, they're defining profit in a little bit, slightly different way. Okay, well, here is an example. We'll get started on this and won't be able to finish it until last time. This is a hypothetical grocery store, Emily's grocery store. We have listed the cost that she incurred. Well, a number of things, okay? We want to figure out, is this an explicit cost? Is it an implicit cost? Is it not either one, okay? She's got a utility bill, labor services, she's paying wages to people. She's got sales to customers, rent on Emily's building. Here we're assuming that she owns the building, and we're assuming that if she had rented it out to someone else, they would have been willing to pay her $18,000 a month. All of these are monthly figures. Groceries bought wholesale, 76,000. So that's what she is having to pay to purchase the groceries that she's now going to resell to her customers. Taxes, 6,000. Interest available on alternative investments, 7,000. We're saying the funds that she invested in her business, if she had invested it elsewhere, she could be getting $7,000 a month. Okay? Then the salary that she could have earned, she could be earning if she were working for somebody else rather than running her own business. And then what she is spending on advertising. What I want you to do is identify which of these are explicit, which of them are implicit, and then come up with I want you to calculate her accounting profit and her economic profit. Okay, you've got all this is the only information that's relevant. So next time I want you to to tell me what her accounting profit is, what her economic profit is. Actually, if you send me an email and if you have the right answers, I will give you 2 or 3 points of extra, 3 points. You get both of them right, I'll give you 3 points of extra credit. Yes.
Is that chart available on the Moodle page?
No, but I will, I'll put this up. I'll put this up on Moodle so that you can see it. Probably I'll send it as an announcement. Yeah, so you'll be able to see that. All right, well, I'll have your grades up by noon tomorrow. Have a good weekend.